Our presentation is going to focus on GBP against USD and AUD against USD. Through analysis, important indicators related to the past and present performance with the United Kingdom, Australia, and the United States, to predict the future exchange rate within the next 3 to 6 months. Relative inflation rate affects demand for exports and imports within a country. If it is increasing, it will result in less demand for exports and currency. Shift the demand curve to the left. Another way around the demand for imports will increase and more supply for currency. Shift the supply curve to the right, and this currency will depreciate against another one eventually. The relative interest rate is being viewed as that increases will lead to more capital inflows and therefore shifts the demand curve to the right. However, discourages of capital outflow could supply curve shift to the left. In addition, the higher interest rate may come higher inflation. The economic growth rate will also affect exchange rate due to affect the demand for imports and investment capital inflow, while the level of commodity price will affect the demand of exports. Expectations future exchange rates can become a self-fulfilling prophecy. Exchange rates are also influenced by intervention by central banks or government in order to float of exchange rate.
Data from the Office for National Statistics and BLS reported monthly inflation rate in the United Kingdom and the United States. As shown in this graph, the inflation rate of US is higher than the UK until February 2017, then began to be lower. In addition, it's obvious that UK's inflation rate was going through a quick growth from August 2016 to May 2017. And it still keeps its record without any tendency of decreasing. The real interest rate in the United Kingdom and the United States also vary quite differently. Published by the Bank of England, in order to meet the 2% inflation target, the Bank of England sets monetary policy with a cut in band rate to 0.25%. In the US, the interest rate has been increasing since October 2016, and as we calculate, the real interest rate in the UK since 2016 are staying negative and falling rapidly. At this point, it starts to varying around negative 2.3, and for the US after 2017, the real interest rate became higher than the UK and tend to grow positively. Furthermore, the GDP growth rate between US and UK has been shown in this graph, support the conclusion that the US has higher growth rate. For future expectation, the pound has risen against most major currency pair after the UK leaves the European Union and the election of Theresa May, making the conversion of pound into other major currencies a more attractive proposition. After the Bank of England meeting, GBP has been up to 1.32 against USD dollar and is expecting toward the 1.34 handle. Meanwhile, the dollar has also been affected by the election of Donald Trump. With the poor economic growth in Q1 2017, most of the people are believing that USD would be depreciating in the future. However, the net influence by growth rate and expectation could be complicated. In order to forecast more accurate, based on the demand and supplies is significant. For GBP, with higher inflation but lower interest and growth rate compared to the United States, the United Kingdom will have less demand for export and more demand for import. This capital inflow and more capital outflow. Although expansion might lead with higher level of investment, the net demand for GDP will decrease and supply will increase. Therefore, shift the demand curve to the left, while supply curve shift to the right. Therefore, the GBP would be expected to depreciate against the USD within next 3 to 6 months.
About is the AUD against USD. First, we will focus on the economic growth rate between last year to this year. According to the data of RBA and the Federal Reserve System of US, the overall economic performance of US represents a leading trend compared with the economic growth rate of Australia from Q1 in 2016 to Q2 in 2017. Only Q1 in 2016, Australia overstepped the growth rate of US, with the difference of 0.4 between two nations. Apart from the GDP, the inflation rate appeared an opposite trend. From the first quarter of last year to current Q2 of this year, the inflation rate of Australia has been increased in a stable speed, with 1.3% to 2.1%. However, the inflation rate of US dropped down rapidly from 2.4 in Q1 last year to 1.7% in Q1 of this year. And until the last quarter of 2017, there's a difference of 0.039 between the inflation rates of both countries. We will turn to the interest rate of this currency pair. As we can see, the interest rate of Australian shows a step-down trend from 2016 to 2017, but the entire interest rate of Australian is basically above the one in US. After the adjust of inflation rate, in the first quarter in 2016, Australia reached a peak of 0.7%, which is much higher than the real interest rate of negative 0.493 in US. Then followed by the real interest rate in Australia sharply decreased until the second quarter in this year. These two nations almost meet the same point with negative 0.4 and negative 0.585. After the evaluation of above indicators, the factor of commodity price also should be considered as a key determinant, as the commodity price can change the value of commodity currency. As the graph shows, an upward fluctuation of commodity price index can be clearly seen in this graph, which year 2010 is chosen by the base year, from 90.4 in September last year to 94.3 in August this year. It is closely related to the two main exporters in Australia, which are the rural and base metals products. This is the graph of the weekly change in base metals and rural commodity price from 2009 to 2017. Totally, it shows a strong positive relation between rural and base metals products. Here is an international news to forecast the future trend of AUD against USD. Australia is the largest exporters in oil and energy. Trump's energy plan will promote the high demand to those Australian domestic commodities, which leads to an increased value of AUD. Also will push up the demand for energy industry. Here is the real data of between two nations. So the demand and supply approach should be used in prediction of AUD against USD in short run. From the analysis, the GDP growth rate of US performs higher than Australia. Another word for GDP growth rate is the national income. The less income people earns, the less supply of AUD. But for the inflation rate, Australia did well than USA. Then the real interest rate, the rate of negative 0.4 in Australia can attract more capital inflow, which increase the demand of AUD, compared with the lower rate of United States with negative 0.76 currently. So here is the forecast of AUD against USD. It would be appreciated against USD in 3 to 6 months.